I'm Daryl Jones, Director of Research at Hedgeye. I'm here today to talk to Stefan Wieler, Director at Goldmoney, and we have a really interesting conversation we're going to have, and it's about silver. Stefan and his team at Goldmoney believe that silver has up to 30% upside, maybe even more over the longer term. So it's very interesting in this, especially in this environment where it's pretty hard to find returns. So with that, I'll just hand it off to you, Stefan, and we're curious to know what the thesis on silver is.
Yeah. So our silver price model we have is basically, it's a model based on a relative price to gold. We see silver, or maybe I have to take a step back first. What do we see gold as? We simply think gold is money. Now, silver is used as money as well, but it is also used as an industrial metal. So it has all the drivers gold has in terms of what makes gold money, like real interest rates, etc. And then at the same time, it also has this industrial component. So it is also, to some extent, dependent on how the global economy is doing. And so if you bring those two together, you can actually form a price framework where you see the relative price from silver to gold. And in that model, we see actually the largest discrepancy we have ever seen since we have data for it.
And then another component of this, which you've talked about quite a bit, is just the short interest. And where is the short interest relative to where it's been historically in silver, and how do you see that playing out as a catalyst?
Yeah, so the short interest is not really going directly into our model. When we saw the large discrepancy, we looked at the short interest and we found that it's not just that the short interest is high, but the change in the short interest was extreme, right? So yeah. We actually came from relatively high net length or high net speculative lengths in silver in 2017, and then there was just relentless selling from speculators, and we think that has actually contributed to that large discrepancy between where silver prices should be and where they're currently at. Now, if you look at the short interest, it was just a few weeks ago when we put our note out, that year-over-year change was at an absolute record. So there was 600 million ounces that were sold from specs over a period of 12 months. And that has recovered a little bit over the last couple of weeks. So we're not that low anymore, but we're still way out of the regular range.
Gotcha. And then, over time, where do you think the price can go? I mean, there's probably a sort of a shorter, you guys put out your report just over a month ago. We've had a bit of a move, but where do you see the price, if the thesis plays out, moving over the next 3, 6, 9, 12 months? I mean, obviously it's kind of hard to predict things like that, but
Sure. If it just goes back to where the model predicts silver prices should be, we actually think we still have about $5 upside from where we are right now. Now, the risk to this, as I said, it's a relative model. The risk to this would be that gold itself sells off and silver just stays where it is. Or the second component gets really bad, so that you really have a downturn in the economy, right. Industrial production collapsing, etc. We don't think that silver as the only metal there is predicting this. So I think still the risk is fairly skewed to the upside here, that when this gap closes, it closes by silver going up rather than gold going down.
Yeah. So just to take the other side of that, though, what would have to happen for gold to go down? Like what type of economic environment or fundamentals would occur for the gap to collapse the other way, like gold to correct?
Yeah, sure. Yeah, no, that's a very good point. So we have just published our updated gold price framework, and it's actually on the Hedgeye website as well. So
Correct.
I encourage everybody to go and read it. We built on what we have already published 2 years ago. Our gold price framework basically finds 3 main drivers of gold prices over the very long run. The first one is real interest rates. The second one is central bank net gold purchases or sales. And then the third component is longer dated energy prices. And so it's very hard to predict what central banks are doing, but over the past couple of years, they have been net buyers of gold. Even how the world looks, I don't expect much of a change there. It's mainly emerging market central banks that are buying, while Western banks are still net sellers. So, for instance, Canada over the past couple of years, etc. But that is actually that's actually probably the least important driver of gold prices. The main two drivers is real interest rates and longer dated energy prices. We've just published a piece where we actually we are pretty bullish on longer dated energy prices over the next couple of years. We see very limited downside from there. You probably would need a real drastic economic collapse, so a 2008 kind of economic collapse to derail that. And then on the other hand is real interest rates. And obviously nominal rates are going up, but we have always argued that even as nominal rates are going up, we don't really see that much upside to real interest rates. If you look at right now 10-year tips, so that's the implied includes the implied inflation expectations of the market. So it's nominal 10-year rates minus implied inflation expectations. And those are back at, I would say, the cycle highs. They almost touched 1%. And if you look at the expectations of where the Fed says that nominal rates will end up at the end of the cycle, we're basically there. So we don't really see much upside to real interest rates and real interest rate expectations. I have to point out, not really real interest rates themselves, but real interest rate expectations. I think we're pretty much to the peak there as well. Okay. So what you would need is the Fed to come out and raise rates much more aggressively than they currently project and the market is currently assuming, and they have to do that all without inflation expectations going up. So the Fed would have to come out and, for whatever reason, basically raise interest rates really aggressively, give a really aggressive outlook. So instead of going to 3%, going to 5 or 6%, but in a scenario where there is no rising inflation. And that's really hard to see for us. Yep. So we actually think real interest rate expectations are also near their peak. They can go a little bit higher, but we really don't see that much upside. And then once we're there, then the next move for real interest rates is lower again. So that's why we think gold prices are skewed to the upside, and that's why we think it's really hard to see the gap between silver and gold closing by gold going lower rather than silver going higher. And
then the only other thing on silver would be the economic impact in terms of industrial production, and I guess your view there is, could soften a little, but you don't see it falling off a cliff.
Yeah, as long as it's the same as with oil prices, right? As long as economic growth, global economic growth, is not completely falling off a cliff, I don't see much risk from that side. That said, should economic growth fall off a cliff, I think then the hiking cycle has ended, and it has ended for all central banks other than the Fed before it has even started. So I can't see how real interest rates are not going lower in such an environment, and that will most likely offset any negative impact we see from industrial demand.
Great. All right, great. Thanks a lot, Stefan. Very interesting thesis, and definitely an asset class a lot of you should be taking a look at. Just based on the narrowing of the range between gold and silver, it's kind of at an extreme right now versus, I guess, the history that Goldmoney, the research team at Goldmoney has looked at it. So there's clearly an opportunity there, and the environment kind of supports it as well. Thanks.
Thank you very much for having me.
Take care.